so we'll get started. For those of you that don't know me, my name is Selena and I am the president of the FCDSA this year. Thank you so much for joining our webinar with CDSBI. CDSBI is a phenomenal resource for dental students. They are a huge supporter of FCDSA, a huge sponsor for the conference, the biannual conference, which will be January 2027 next year. So keep an eye out for that. And you'll likely be able to see them there as well. So without further ado, I want to introduce CDSBI, as well as we do have a special guest, Sam from MNP. Take it away.
Thank you so much to the FCDSA and Selena for the warm introduction. Hi, everyone. I'm Andrea Medina Vera, Early Career Education Specialist at CDSPI. Today's session is called Finance Unplugged because the goal is to talk about the financial questions that you as dental students actually ask without jargon and without pressure. Tonight's all about giving you clarity and confidence. I'll be moderating today's session, and I'd like to call on our panelists to introduce themselves, starting with Julie.
Hi, everyone. My name is Julie Bertham. I'm the Senior Insurance Advisor with CDSBI. Hopefully, a lot of you have seen me at various school presentations throughout the years. So I'm here to help. Any questions, please feel free.
So my name is Shane Dooling. I'm an investment planning advisor. If you are in Saskatchewan, you probably already know my name because I always ask you guys. That's the first thing I ask. What's my name? Any rate, I'm very happy to help you out. If you've got any questions at any time, please do not hesitate to reach out to me.
And I'm Sam Terabane. I'm a partner here at MNP, so mainly an accounting and tax firm, although we do a variety of things and we're across the country, coast to coast. I specialize in working with healthcare professionals such as dentists, and I do other things as well with physicians and other professionals as well. About 10 years of experience in this specific field, so I'm happy to be here and happy to answer any questions and the like. So appreciate having me on.
Awesome. Thanks so much, everyone. So here's a quick look at what we're going to be covering today in the panel. I'm going to start with a brief overview of CDSPI. Then we're going to touch on some topics in the panel section about debt versus investing, protecting your future income, some smart banking basics, and early tax and record keeping tips. Most of our time is going to be spent in the discussion and Q&A. We want to keep it conversational. So again, please feel free to pop in your questions in the Q&A, and we'll wrap up with the prize draw at the end. So, starting with why CDSPI? Who is CDSPI? CDSPI is an organization by dentists for dentists. We're a not-for-profit, and that structure really matters. It's our focus for long-term outcomes for our members and not sales targets. We support over 13,000 dentists across Canada with insurance, investing, planning, and education tailored specifically towards dentistry from school to early practice and beyond. Today isn't necessarily about products or super long presentations. It's to help you understand the decisions in front of you and a space for you to ask questions so that you can feel confident in navigating the next steps of your life. So here, I like to start because this is how most of us imagine the next few decades of our lives going. You graduate, you start working, your income goes up, and life moves forward in a predictable way. And there's nothing wrong with this. It's most of how most of us picture our futures going. But even at this stage, dental students like yourselves are already making a lot of real-world financial decisions around debt, lines of credit, insurance, and saving, often before earning your first dollar as a dentist. However, life sometimes can be unexpected, and this is just a reminder that life doesn't always follow that neat vision that we always imagine. So no one necessarily plans for these things, but they do happen. Careers shift, markets change, health issues come up, and personal situations evolve. When most of those moments happen, the question isn't whether they affect your finances necessarily, it's how prepared you are when they do. And that's really the context around today's conversation, understanding the decisions in front of you and how seemingly small choices now can make things easier later. And then this brings us to why having the right people in your corner matters. Not necessarily that you have to have everything figured out today, but to help you navigate those decisions as they come up. And without further ado, we're going to jump into our panel questions. How should dental students balance paying down debt with saving and investing early? This question is for Shane and Sam.
Okay, I guess I'll go first. So, effectively the balance that you're looking at is when you are looking at what your cost of borrowing is, right, which is your interest rate, versus what you can realistically expect to get as a rate of return. And then you have to look at what your timeline is as well as to when you're going to need to use those monies, right? So ultimately, if you find yourself in a situation where your cost of borrowing, your interest rate on your debt is, say, 7%, and you look at the historical returns for the investment that's appropriate for you in your time frame, and that, let's say, is 5%, well, the answer is pretty simple. You pay off the debt because it's got a higher cost there, right? Reverse, say your rate of return is, historically 7, but your cost of borrowing is 5. You could make the argument, hey, as long as that after tax is as long as that 7% is after tax, hey, the math tells me I should, invest versus pay down debt. Here's where I'll say it depends, though. Some people out there are just flat out debt adverse and they just don't feel comfortable having debt. So they want to get rid of it as quick as possible. And that's fine. Right. But what I do here, one of the things I do here is help you make that informed decision to say, all right, says here the math suggests that we should, invest versus paying down debt. And then ultimately you're the boss. It's up to you to make the decision as to what you want to do. I've given you the reasons and I've given you the rationale. It's now up to you to make that choice.
Yeah, and I would echo a lot of that. I would agree. I've had very similar conversations. You know, it, the tide kind of changed over the last several years where we saw the prime rate of interest really changed. You know, it wasn't too long ago where prime rate was around, I think it was 2.45%, something along those lines. And so it's a much different conversation when interest is almost 2% and versus now, well, it's come down, but it was higher throughout the last couple of years. So, you know, when you're looking at it in the fives or even 6% range. So it's a, you know, I always pose the question, you know, and kind of what Shane said is, what's your cost of borrowing? If you pay down debt, it's kind of a guaranteed rate of return in a sense, right? You're guaranteed to save that interest. It's maybe a bit more conservative. But if you can go to the market and make more, then financially you may be better off. It's just what you prefer as an individual. If you can't sleep at night with the debt, then I think that's maybe where you focus. So it's about where your priorities are and what your tolerance for, you know, risk tolerances and what you want to accomplish. So there's merit in both. I just think it's a very personal decision as to which way you're going to go.
Yeah,
100%
thanks so
agree.
much. Thank you both. Moving on to our next question, which is very deeply related. What do students need to know about accounts like RRSPs, TFSAs, FHSAs, etc.?
I guess I'll take this one. So, they each have their own basic purpose. And so if you look at, for example, an RSP, the RSP is used to essentially do a few things. One, you're trying to save for your future, and you're trying to do that in a tax advantaged way, but it can also be used to help fund a first home buyer as well. Okay. But your RSP, for the most part, is for a long-term approach to investing for your future. Okay. As a rule of thumb, you could reasonably expect if you're earning, you've got to have earned income, I might add. If your earned income is around sorry, if your contribution is around $10,000, it is not unreasonable to expect a basic tax refund in the neighborhood of about $3,000. Okay. So that's RSPs. They help you in terms of saving long term. You can invest in funds, stocks, bonds, GICs, the works. Okay. The next one is the tax-free savings account. So the tax-free savings account, in the name, you hear the name account and people think of it as a bank account. It's not. You can invest exactly the same way as you invest in an RSP. There's nothing different in that sense. The main difference is you will not get a tax refund for contributing to a TFSA. You can invest in a TFSA for the short term if you want, because when you draw the monies out, there's no taxation at all. Whereas when you eventually draw money out of an RSP or hopefully convert it to a RIF at a certain point, you will be facing taxes on the monies that you draw out. Therefore, a TFSA is a little bit more flexible, except again, you don't get the refund that the RSP provides you. There's also differences in terms of the limits that you can contribute into a TFSA versus an RSP. You don't want to over contribute in either case. If you do so, the CRA will charge you 1% per month on the overage. So yeah, you want to make sure that you're not over contributing. And then finally, the first home savings account, which is somewhat new. It's essentially been put in place so that you can save money towards buying your first home, as the name sounds. And once again, you can invest exactly the same way as you do in a TFSA and an RSP. It too has contribution limits that you have to be aware of. It's a nice little assistance in terms of saving money for buying a house, but it's not the be all end all. I think in a lot of cases, you're going to find that you're still going to want to use the first home buyer's option within the RSP and possibly your tax-free savings account as well. So yeah, that's pretty much what I would say you need to know. Does anybody else have anything you want to add to that?
I think you covered it pretty good. Like I think those are, especially as you're moving out of school, those are common accounts to start to look at and start to consider when it makes sense to put money in. Again, it goes back to the question of, well, do I pay down my debt or do I look at these accounts as a means to invest? Again, it depends on your goals too, right? Like, I have some clients who come to me and they say, well, I'd like to buy a house within the next 2 or 3 years, right? So if that's the case, you might consider opening up an FHSA and maybe adding 8 grand a year to get that in, right? Because the account has to be open to get the room, and then you have to contribute to continually get that $8,000 a room. Like you can't wait 3 years and get a full 24,000. You have to have the money in there per year to continue to have the room. So again, it kind of goes back to what your goals are. And as Shane said, the RSP, you have an option there too. You could put money in up to your limit. And as long as you withdraw it up to 60 grand for your first home purchase, there's no tax on that withdrawal. You do just have to have the money in the account for a minimum of 90 days. So
Yeah. And
there's
you have to pay it back.
and you got to pay it back over 15 years. So
Yeah.
actually, no, they extended that. I think it's actually longer. I got to go back. I haven't looked at that in a little bit, but you do have to pay it back. Either way, there's a couple accounts here that can really help push you into buying that first home or give you a good head start on that. If there's I always, again, the FHSA is an account to consider. You know, maybe it depends again when you want to buy that first home. If you have that time frame within a couple of years, if you're still in dental school, you could open it up now to get the room, right? And you might say, well, I don't have the money to do it, and that's
Doesn't matter.
fine, right? You can carry it forward 1 year, and maybe next year's the time. Or the other nice thing with the FHSA is that even if you could put away 8 grand per year, we can carry forward that deduction to a future year, right? So you can get the money in there, but we can take the deduction in a future year when maybe you have higher income. So there's some playing around and some planning we can do there. But again, it kind of boils down to what makes sense for you and what you it's impossible to plan for everything, but if you have an idea in mind, it's good to talk to your team so that we can put things in place.
Yeah, thanks so much, guys. I guess we covered a huge basis here, but are there any other types of investing accounts or savings accounts that students should be setting up while they're in school or using when they graduate? It was a question that we had submitted from the registration. So,
Yeah, so there are a number of other accounts, but they're not necessarily pertinent to, students. So for example, you can set up an RESP if you've got kids. You might want to put some money away so that your kids can afford to go to school. As you are dental students, you all know how expensive it is to go to school. So therefore, any money you can put aside right away only has a longer time to grow. So that's one thing. And then once you graduate and you start getting into things like potentially practice ownership, You're certainly going to want to look at incorporation, in which case then you can open up a corporate non-registered account, in which case, in that particular instance, you can save corporately earned dollars inside that investment account. And those corporately earned dollars are taxed at a much lower tax rate than your personally earned dollars that you're contributing to all of the three accounts that are on the screen right now.
Our next question is for Julie. What kind of insurance do dental students need?
So as a student, this is the perfect time to get insurance when you're young and healthy. I would say outside of, malpractice, which I'll probably address a little bit later, your number one most important insurance is disability. Because as a dentist, you are a self-employed individual, which means that if you become disabled, you cannot make a claim through the government EI benefit. Instead, you do need to rely upon your disability insurance. And I'm not sure if everyone is aware, but there's been a lot of change to the disability market for students in the last, or not necessarily for students, for dentists in the last several years. So, for example, in 2022, Manulife decided to stop offering disability insurance entirely. They just don't do it anymore. And in 2024, Canada Life decided to stop offering own occupation to dentists. And I want to stress how incredibly important own occupation is. So, if no matter where you take your insurance, of course, we would love to have your business, but please make sure your disability policy has own occupation. What that simply means is that if you became disabled and you can't be a dentist anymore, but you're too young to retire, you're going to have to choose another career. Because dentistry is, rather lucrative, the odds are that other career is not going to make you as much as dentistry did. And so if you do not have own occupation, then in that scenario where you start to earn an income in another career, your disability benefit stops, even if this new income is less than what dentistry made you. Whereas if your disability policy has own occupation, then you can still receive your disability benefit, even though you are now earning an income elsewhere. So please, please, this is so, so important. Make sure that you do get it. I also just wanted to point out about our disability policy because there seems to be a lot of confusion in the years I've been doing this about this. Our disability product is a guaranteed non-cancelable policy, meaning that once you have it, that policy is locked in. And it's not now nobody can change it except you. Even if CDSPI went out of business, which I assure you we are not. Um, thank you for the backup. Your disability policy is guaranteed to be taken over by the insurance company. So there is no risk in it. You have that peace of mind that the policy is there to protect you, and no matter what should happen in the world or the industry. So I cannot stress disability is number one, and it's not something that you just put on the back, you get once and put on the back burner. You do need to review it over time as your income grows.
Yeah, awesome. Thanks so much, Julie. And that's a great segue to our next question is what are some common insurance myths that we see out there?
That's great. And I kind of addressed a little bit of that already with regards that because I know other advisors and brokers out there, I've heard you guys tell me directly that they are saying to you that CDSPI can cancel your insurance because it's group insurance. And that's simply not true. Yes, it's group insurance, but what that in actuality means is that we only deal with one group of individuals, which are dentists. And because we only deal with one group of individuals, and which dentistry is a rather low risk profession, you're not tightrope walkers or construction workers or anything like that, it means that we can keep our premiums lower. That's what group insurance means. It doesn't mean we're going to cancel it on you. So please rest assured that just because it's group insurance, it does not mean that it's bad. Another myth that I see a lot of the time is, you guys graduate, you start associating, and you think that because you are an associate and you don't own the practice, that you don't need office insurance. And that is completely false as well. Because remember, I said earlier, you are a self-employed individual, which means if the office that you are associating in, if something happens to that practice, there's a fire, there's a flood, there's a vandalism and break-in, anything like that. And if the practice has to close for repairs because of that, you have no income during that closure. The practice owner's policy is not going to cover your lost income. So it is very important. And yes, you do, sorry, you do need office insurance. And we have an associate version of our office insurance that's very economical. So once you guys graduate, I do encourage you to reach out to us to discuss that more so that we can see what's best for you and how to better be able to protect you, protect your income, protect your future, and your livelihood.
Thanks, Julie. And we did have a question pop up in the Q&A
Sure.
that I think is for you. Is there a reason why it is recommended to make at least 250,000? Will it work for a lower income? And I believe that's asking directly about our disability insurance.
Um, I mean, there's not a requirement to make a certain amount of money. You can make whatever income you want. It's just the amount of disability insurance that you can have is based on income. And that's the fantastic thing when you're a student is that we don't ask you for proof of income. So I encourage everybody to get our optional graduate package, which I'm sure you've heard me or one of my colleagues speak about over the years. It is a medically underwritten insurance, but it's going to give you higher amounts of coverage than if you just did our basic non-medical application. Now, what would happen if you do have that one is when you graduate, you would have 3,500 in disability. This is equal to about a $70,000 income. Certainly, you're all going to make far more than $70,000, or I'm sure, Sam and Shane hope you do. Um, so what happens is this is just a base amount to get you started. Like I said before, don't just get it once and put it on the back burner. As your income grows, you are going to need to increase coverage to match your income because I've seen it happen before where a dentist graduated, they work for 20 years, and then they become disabled. But they still had the same amount of disability insurance that they had when they graduated, which is certainly not enough, nowhere near enough to cover income that you've grown over 20 years. So please do make sure that you are updating that. I know insurance can be overwhelming for all of you, and you've got a lot on your mind. You don't have to be the expert in insurance, investments, taxes, anything like that. That's why we're here to help you. Just what I usually say is call us at least once a year just to do a review, make sure everything's still as it should be. And also, I'm sorry, also at any major milestone in your life. So getting married, having kids, opening up a practice, retirement. These are all major milestones in which you should be reviewing both your insurance and your investment portfolios. I hope that answers the question.
Thanks, Julie. Although I did get word that that was a question in response to something about incorporation that was earlier in the Q&A.
Okay.
So I just wanted to reiterate that everything that Julie said is very important and very valid. We are going to be talking more in depth, specifically only about incorporation in a few questions. So we'll answer that more fully very, very shortly. So going right into it, what tax habits should dental students start now?
Yeah, so I think there's a couple things maybe I would consider just when we kind of think about dental students specifically. Um, you know, it's no secret that a lot of you are paying quite a bit to go to dental school. So you're accumulating student debt in a lot of cases, but also you've accumulated tuition tax credits, which are a key when you go to graduate and start to earn income because those tuition tax credits will help cover some of the taxes that are going to be triggered in your first and maybe even even in the following tax year. It ultimately will depend on how much you make in the first kind of year and a half or so. But typically, tuition tax credits, you want to make sure that those are fully available to you. And it's a very common thing that CRA reviews, right? CRA will typically send out letters. And I'm sure most of you have gotten this at least once, but they see how much tuition you're reporting on your tax returns. They will typically ask to review the tuition slips and anything else relating to that. What happens if you, let's say, don't live where your home address or where you grew up, and the mail goes there and nobody opens it, nobody responds, or you forget. CRA will just deny the tuition tax credits. So ultimately, what happens is you start working, you start making money, then you file your first tax return with income, and you're missing tuition tax credits. So there can be some significant amount of money that is, in tax savings that are missing if those aren't in place. So it's good to have a good check of what your level of tuition tax credits are. Does it make sense? Has there been any denied amounts? And if there has been, going back and having them fixed, right? Because that you still have the opportunity to go back and get them fixed. It just sometimes it takes time if CRA has already been through requested a review and then denied it. It'll take some time for them to open it back up, review it, and then grant them again. So I think that's a key thing to keep in mind. Um, you know, that's kind of a major one, I would say. And looking at some of those answers that I saw about deductions and what you make and all that, I think it's a good habit to keep track of what you're spending in two parts. One, from keeping track of your student debt, right? Because the debt that you incur now during school is going to have to get paid back. And although some of the provincial and federal loans, there may not be interest yet, or there's no interest at all, it's still debt to be paid back. And if you have lines of credit, those are incurring interest as you kind of speak. So, being mindful that what you put on there now is going to impact your ability to save in the future, to invest in the future, and it'll impact, what you're going to do and how long it takes you to when you want to retire. Like all those things, it's kind of you know, a domino effect, if you will. So I'd say those are important things to keep in mind as you kind of leave dental school and looking to repay that debt.
For sure. Thanks, Sam. We also had something pop up in our Q&A as how can a student check how many credits they're going to have?
Yeah. So if you have CRM at online access, there's an area to check your carry forwards, and there'll be a spot for tuition, and it'll show it kind of broken down by year and what the carry forward amount is. You can also look at your notice of assessment. So, keeping in mind if you've been through undergrad and through dental school, if you kind of add up roughly what you paid per year, it should give you a decent frame of mind or a frame of reference, I should say, to approximately what should be there. I know some parents get transferred, up to 5 grand, so that could come into play too. If your parents are transferring that, or if you were transferring it to them, so that might lower it, but that'll be where you can check what you have carried forward.
Awesome. Thanks so much. Moving forward, this one is for Shane and Sam. You can feel free to chip into this one as well. Uh, we kind of answered this a little bit already, but if there's anything to add, what are the risks to using a student line of credit to invest, and how could it affect their credit?
Yeah, so simple. Your investment isn't guaranteed to go up, but you are guaranteed to have to pay that debt back. And especially gets problematic if the interest rates are going up. Now the amount of payment you're paying back to the bank is also going up as well. And you may not be able to budget for that. So that could be a problem because if you're not able to pay it back because interest rates have gone up, if you miss a payment, your credit score is going to go down. If your credit score goes down, it'll affect your ability to get a mortgage later or to get a loan for buying the practice, perhaps. So there's all sorts of different things you have to worry about. You just have to remember that, when you're borrowing and to invest, that's called leveraged investing. And it comes with that additional risk of, oh yeah, I have to pay that back no matter what my investment does.
Thanks, Shane. Great answer. And can you shed any more light on how credit scores might work? Like, is it something students need to be concerned about if
With no
they're,
question.
really using their line of credit?
Yeah. So basically, bottom line is, it's okay to have credit, right? That's not a problem. In fact, I would highly recommend that you get credit early so that you can establish your credit history. The problem becomes is when you start missing those payments. If you are behind on a debt by 30 days or 60 days or 90 days, these are all checks against you. And when, a credit company, whether it's a bank or whatever, is looking at your, credit worthiness, they're going to find out from the credit bureaus saying, hey, this person is having a hard time paying back this debt, as an example. And so, what will happen is that, yeah, they may still lend you money, but they might charge you a higher rate of interest, right? So first, you might not get approved at all. And second, if you do get approved, you might have to pay a higher rate of interest because your credit rating isn't as good, right? So these are things that you need to concern yourself with when you're, borrowing to do this, that, and the other thing. The other thing you don't want to do is you don't want to apply for credit everywhere willy-nilly, because those hits on your credit bureau, because every time you apply for credit, there's a hit on your credit bureau that also pushes down your credit rating. So, you might be thinking, oh, I'm not doing anything wrong. I'm paying my debts back. I'm just applying for a credit card, all 5 different banks type of thing. And that's not going to help you either, right? So you just, you need to be mindful of that. If you don't have, any sort of credit at all at this particular point in time, or you're looking to establish some credit, a good way to establish credit is to take out something like an RSP loan and then pay it back with your refund from your taxes. That's a great way of establishing some credit, a history, I should say, and making it so that it becomes easier and easier for you to get any sort of credit later on down the road.
For sure. And just a quick one from the Q&A section is how many years does it roughly take to pay off dental school debt?
Well, okay. I can tell you when I do a financial plan for my clients, traditionally, most students or clients, I should say, are trying to have it paid off in 10 years.
10 years.
Yeah.
Thanks for that.
So,
And then we
but
did
I mean,
also have
it's
one.
really, but it's very dependent on the individual still, right? I mean, if you're really debt adverse and you've got the income to pay it back sooner, again, look at paying it back. But I'll also say that the qualifier there is if you've got any other debts or anything else, you need to look at the percentages again, right? In that, yeah, if my dental debt has a rate of interest of 4%, but I've got a line of credit and a credit card that are charging me 10 and 19, well, you pay the higher interest rate back every single time, right? That's the one you want to, be more aggressive in terms of paying back.
Awesome. Thanks so much, Shane. We'll move forward. This one's going to be for Julie again. What types of insurance coverage is important when starting to practice?
Okay, so there's a few that we can talk about here. So first and foremost is your malpractice insurance. As I mentioned earlier, I was going to touch on that. If you are going to be practicing in Canada anywhere other than Alberta, Ontario, or Quebec, your primary malpractice is with CDSPI. If you are in Alberta or Ontario, your primary malpractice is going to be with your licensing body for $2 million in coverage. But if you wish to have a higher amount, you can buy an excess malpractice with CDSPI. So outside of those provinces, I will touch on how getting malpractice works because this is a super common question around graduation time. So malpractice and your license go hand in hand. You cannot have one without the other. So you do need to apply for both your license and your malpractice at the same time. When we get your application for malpractice, we will reach out to the licensing body to let them know that you have applied and to ask what date they expect to activate your license so that we can activate the insurance as of the same date. Now, when you graduate, if, for example, you're going to take the summer off and you're not going to start working until the fall, you may want to postpone getting your license until the fall because if you get your license, you must have malpractice regardless of whether you're working or not. So that's your first and foremost insurance that you get as soon as you are ready to practice. As I mentioned earlier, uh, get your triple guard office insurance. That's important. Make sure you're updating your disability insurance as the income progresses and increases. And lastly, and this is one that's not so common knowledge, if you are going to own a practice, there's an insurance called office overhead. Because when you own a practice, if you become disabled, you're still responsible for the expenses at the office, like rent, utilities, staff salaries, and so on. This is precisely what office overhead is for. If you do not have office overhead and you own a practice and become disabled, all of those expenses are going to come out of your pocket. Can you really afford that? Uh, the last thing I'll just kind of touch on for that is if you intend to buy a practice, the bank is going to ask you for life insurance as collateral for the loan. Don't leave it till last minute. Getting life insurance is not an overnight process. It takes time. And I cannot tell you how many times I have had dentists call me sitting in their banker's office saying, I'm buying a practice tomorrow. I need life insurance. I just can't do it overnight. So please, if this is on the horizon of your plans and your future, start early. Also, getting that life insurance when you're young and healthy, hopefully, is going to mean that you're going to hopefully have a lower rate. Because what if, you wait and, you develop some sort of medical issue, not that it makes you disabled, but it might make it to the point that you can't pass an insurance medical anymore. And so then how are you going to get the life insurance to be able to provide as collateral to be able to buy that practice? And the last thing in regards to life insurance is the bank may try to offer you something called loan insurance, or, when you're buying a house, mortgage insurance. If you already have life insurance, then you can assign the life insurance to the bank. And even if you don't already have life insurance, if you obtain life insurance to assign it to the bank, this is often much cheaper than that loan insurance. Because the way the loan insurance works is you don't have to qualify for it, so they just charge you a higher rate. And as you repay that loan, the amount of the insurance decreases. And when you're done repaying the loan insurance is also gone. However, with the life insurance, if you assign it to the bank, it accomplishes the same thing. If you should pass away and there's an assignment on your life insurance, we reach out to the bank and say, how much did Dr. So and so owe at the time of their passing? And that's all that the bank gets, and the remainder goes to your beneficiary. And when you're done repaying that loan, we can remove the assignment and you still get to keep the life insurance. So I think those are just things that I wanted to touch on with regards to buying a practice. Obviously, there are other things that have become more relevant risks in recent years, such as cyber insurance, and this is something that we do also offer as well. But obviously, give us a call when you're starting to think about purchasing a practice, because you're also going to need to secure funding for that. And then we can discuss what's suitable specific to you, because it's a very different situation if you're buying a practice versus you're building one. And we'll just talk at that time as to what's going to work for your situation.
Awesome. Thanks, Julie. And then we have a quick follow-up as well in the Q&A. Does office overhead insurance also cover the set salary you pay yourself?
No, because your salary is going to be covered under your disability insurance. So that so our disability plan is called Disability Guard. So both Disability Guard and office overhead are both forms of disability insurance. But the Disability Guard insurance is there to replace your income, where the office overhead is there to replace or cover the costs at the office.
Thanks, Julie. And then I have a quick follow-up on insurance for actually Sam on this one. As dentists move from associate to practice owner, how does the way that the insurance is set up, like in terms of like personally versus through this business, start to matter from a tax standpoint?
Yeah, so this is a good question because typically when you are self-employed and you haven't incorporated yet, you typically have all, the disability, critical illness. You may or may not have life again. That kind of depends on personal situations, but most of those are all held personally, the critical and the disability. And so we don't typically deduct those for tax, right? Those are not tax deductible. Malpractice is, but disability and critical illness are not. So when you incorporate, we still look to keep those personally in most cases. And the reason being is if they're paid for personally using after tax personal dollars, and hopefully you don't ever need to collect on them, but in the event that you do, they're received tax free. So we want to maintain that generally. Now, are there some tax plans around critical illness and stuff like that? Yes, but again, that's a discussion to have with an accountant and with your insurance advisor to see if that makes sense for you. But traditionally speaking, you keep the critical illness and the disability at the personal level to not have to worry about a tax impact in the event that you have to collect them. The other thing I'll mention too is regarding life insurance. if you incorporate, life insurance can be held corporately. The corporation has to be the beneficiary and the policyholder. There is some tax advantages to that because you can use corporate dollars to pay the premium. So if you think about it this way, in Alberta, the corporate tax rate's 11%, right? So if you have, using easy numbers, if you have $100,000 left in the company from profit, you'll pay tax at 11%. You have $89,000 left over, you can use that to pay for the life insurance premium, right? Otherwise, if it's held personally, you have to pay a layer of personal tax. Let's say it's 36 or 40% or whatever. Then you have after-tax personal dollars to then pay that same premium. So it ends up being, it's cheaper to do it through the corporation. Now, to not throw another wrench into the mix, this becomes something we have to deal with later if there's a whole life policy. So whole life policies are, there's an investment component and stuff like that. Now, if you're a practice owner, there may be situations where you would consider having that in a holding company or moving it to a holding company in the future. Because if you have a practice, you want to sell a practice, and life insurance can be a tricky thing to deal with, specifically whole life insurance, that is. So there might be things to take, steps to take into place early on so that it becomes less expensive. But I think the one takeaway I would say here, without getting too deep into it, is that if you have corporate life insurance, just be aware of which one you're doing and where to hold it, whether it's personal, corporate, or maybe even in a holding company, because there is tax impacts to having it.
Awesome. Thanks, Sam. So going into this next question, what's one tax mistake new grads regret not knowing sooner?
One thing that I've seen that I think is, it's not even, the big thing is, okay, well, keep track of your expenses so you know what to claim. That's, and don't save it all for the last minute and stuff. I mean, there's no timeline aside from getting your taxes filed on time, but if you're keeping track of it continually in like an Excel sheet or something like that, it's easier to make sure you're capturing everything, right? It's a little more tedious. You have to go through your monthly statements and pick up, okay, I had this, I got the receipt here. It's a tedious thing. It's easier to miss stuff. If you do it kind of consistently through the year, it's easier to keep track. The other thing, and it's a common question I get kind of as people leave dental school and are working as an associate, they have a line of credit they want to pay off. And so what a lot of people do is they take their full associate pay, they don't worry about the tax piece, and they just throw it on their line of credit, right? And then what happens is tax time comes around and you got a tax bill to deal with. They pull it back from their line of credit. Generally, I have no issues with that, right? Because it'll help hit down the principal more and save you interest kind of in the long run. But you just want to make sure that your line of credit stays revolving, right? You don't want that to automatically turn into a loan. And if you've been putting lump sums of money on that and you haven't saved any for tax, and then it converts to a loan and now you have a tax bill, you now have, sure, you have a lower debt, but you have now no cash to pay your tax in the year. And if you go to the bank to ask for a loan to pay your tax, they're generally not going to give it to you. So make sure your line of credit stays revolving if you're going to do something like that, so that you're not having to worry about being cash strapped in the event you need to pay your tax.
Awesome. Thanks, Sam. So coming into the question, should new grads incorporate as soon as they start working?
Yeah, I can jump in here. I more often than not would say probably not, right? And there's a couple of reasons. One, and this is my experience. Again, everybody's going to be a little bit different in terms of their tolerance with debt and how fast they want to clean that up, right? But even if you consider the debt piece aside, if you're coming into practice right away, or in mid-year, because most people finish in, call it June. So we have July or maybe even August if you have to wait to get your license, till the end of December. So there's a period of time there where you're working, but your personal income isn't going to be all that high anyway, right? You're only going to have anywhere from 4 to 6 months of actual income. And so you're not likely to be in the top tax rates to really worry about incorporation just yet. Plus, adding that to clearing off some debt too, again, I would say more often than not, I'm not recommending. I mean, again, most people don't incorporate right away. I think that's a bit of a misconception that as soon as you're done, you need to incorporate. Very rarely am I saying you should do that. Sometimes does it make sense if they have no debt? Sure. that might be an option. But again, there's other things we can look at before. It is more expensive to incorporate, it's higher costs. So you need to be cognizant of that when you're leaving school. Like I said, more often than not, they are not incorporating as soon as they start working. Um, Typically, in my experience, it is a few years in, I would say, is on average. Again, it kind of depends on how quickly that debt gets cleaned up. That's usually the number one is, and other common things are down payment on a house if I need cash for that. Am I paying for a wedding? I need cash for that. If you're in a position where if I'm talking to somebody and they say to me, I want to pay my debt down as soon as possible, right then and there, I would say, okay, well, I don't think incorporating is going to be right for you. Now we can run some scenarios and that may reshape how you think about it. But if it's going to be where you set up a company and you want to strip every dollar out to put down on your personal debt, the corporation's not giving you any sort of benefit. Having a professional corporation is only beneficial if you are leaving money behind. If you are spending less than what you make, then you can argue a professional corporation makes sense. But if you need every dollar personally, which again, saving for a house, saving for a wedding, paying down lines of credit or student loans, if there's not much left over there after doing those things, generally incorporating doesn't make sense.
Yeah. Anything to add there, Shane?
I was just going to say that's why you need to have a certain amount of, revenue coming in to make it make sense because of the upfront costs from legal and accounting to the recurring cost. You need to be able to make it worth your while to be able to save money inside the corporation. That's where the big bang for the buck comes.
Yeah. Yeah. So again, it's very situational. You know, if somebody is making 300,000, but they tell me, Sam, I need to spend 16 grand a month because I have all these other things to take care of and I want my debt gone as soon as possible. Even then, even if there's a scenario I can map out where it could make sense, incorporation for that person, we may defer just because there's no sense in setting it up if I'm going to get an email every few months. Hey, Sam, I need to take money out. How much tax do I got to pay? Right. If it's going to bother you to have that debt, then maybe waiting to set up the corporation makes some sense. Again, there's scenarios they can run. You can do a bit of everything. We have plans like that out there, but you just kind of have to think to yourself, what's most important to you?
Awesome. Thank you. This next question is for Sam again. At a high level, as dentists move from student to associate to owner, when do tax strategies like income splitting start coming into play, if at all?
Yeah, I think it can come into play as soon as you're working as an associate. You don't necessarily have to be incorporated to utilize income splitting. Um, for background knowledge, what income splitting is you can pay a spouse or even a family member a reasonable salary for reasonable work done, right? It would be what you would pay an outside party to do the same, roles and responsibilities. So if you're an associate and you're making 300 grand and you have a spouse who, let's say, makes zero, but the spouse is doing bookkeeping for you, record keeping, administrative duties, they're running errands and picking things up for you, you can pay them to do that, right? Now, what that number looks like, again, it should be what you would pay somebody else to do that same work. So if it's 10 grand a year, if it's 50 grand a year, it's going to depend on the situation. But you can pay them a wage that's deductible for you. So you save at your tax rates and they pay tax at their tax rates. So effectively, as a household, you can save a significant amount of tax doing stuff like this. So you don't have to be incorporated to do it. It can be done while you're a self-employed individual.
So thanks for that. Are there part-time insurance rates for dentists who only practice part-time?
Okay, I'm assuming this is referencing malpractice, and the simple answer, no. Because malpractice is linked with your license rather than if you're working or how much you're working. So if you're licensed, you must have malpractice, and there's unfortunately, no part-time malpractice for that. If you're referencing disability, well, if you're only working part-time, then you're only going to apply for an income for disability insurance that matches that part-time income. So I hope that was short and sweet and answers that.
Thanks, Julie. Lightning round for all of our panelists. If you could give dental students one tip around finances, what would it be?
Get a financial
Shane's gonna
plan.
start.
Financial plan, guys. I know you might not think you need a plan right now, but the sooner you get yourself putting pen to paper, if you will, as to what's important to you, mapping out when you want to have things done, what you're able to do to try to achieve that, the easier it'll be. You wouldn't just jump in a car and drive to Florida without having a GPS or a map. Same thing can be said about your financial future, right? Have that financial GPS so that you know the best route to go to get to where you want to go.
Thanks, Shane. Sam?
Yeah, I think that's a really good point. And I just to and I have another point I'll make, but just to kind of add on to that, because I think it is very smart to do that. Sometimes you don't realize what the time value of money looks like and compounding. So when you might say, well, I can put off putting away even if it's 10 grand or whatever the number is, but you kind of lose track of what that compounding really looks like. That 10 grand might be, I mean, Shane will probably quote, I'm just going to throw a random number. That 10 grand might be 80 grand after, 15 years. And that's just one 10 grand investment. So compounding that over time becomes very valuable. So having that financial roadmap, I agree, is huge. The other thing I'll mention, kind of where I was thinking, was um, ease into your lifestyle. Generally dentists and other healthcare professionals have very lucrative careers. You make good money. However, it's very easy to let lifestyle creep in and all of a sudden if that ramps up too quickly and you forget about the other things, again, like Shane said, financial roadmap, paying down debt, saving for tax is a big one. If you ramp up that lifestyle too quickly, that will get you into financial trouble, right? If you don't pay your tax, CRA is not a very nice bank. They will get their money. They will freeze your accounts. They will take it from you, right? Um, you don't want to be there. It is difficult to crawl out of that hole if you get into it, even as a high income earner. If you're used to spending this much, typically to crawl out of that hole, you need to reduce your spending to this. And it's very difficult to do that if you have years of being accustomed to spending this. So ease into your lifestyle. Nobody's saying, you want to get a new car, get a new car. But you might not need the Lamborghini in year one. So just ease into those things because some of these decisions you make will impact you later. And kind of some of the things we see is a lot of people leave dental school in a very similar situation. Have some debt, no income yet, but where people end up in 25, 30 years are vastly different. So making right choices early on is huge.
Thanks, Sam and Julie.
I guess that kind of plays into my answer about making the right choices is also don't don't just put insurance on the back burner and forget about it. It is very important. I know a lot of, young people have that mentality of, you're young and invincible, you don't need insurance, but anything can happen to anyone at any time. I have seen dental students become disabled. I've seen dental students pass away. And if that can happen as a student, it can happen as a new dentist, an established dentist, a retired dentist. So don't forget about insurance. Please make sure you have it and keep it up to date. Like I said earlier, you don't have to be the expert in it. That's why we're here. Give us a call and we'll be more than happy to help you with that.
Awesome. Thank you so much. Is it worth working part-time as a student and paying off some of the line of credit?
Well, it depends. Is it going to impact your grades? Obviously, you want to pass. You want to get your licensing all in a row. But yeah, I mean, if you can manage working part-time while being a student and paying off, debt, there's not a bad thing to that. But again, I just don't want it to impact your ability to be the best dental student possible.
Yeah,
I'll put it to you this way. Sorry, I have one more thing. I have a daughter who's in fourth year. I've not made her work during the school year.
and I don't think I've seen anybody work part-time during dental school in my years of doing this. I haven't seen that. I yeah, I'd agree. I mean, if you can do it, great, but I think it'd be relatively difficult. And I think you put your time and effort what's going to, you know, help you make the most money in the future. So short-term pain for long-term gain.
Awesome, thanks. And now moving on to the two Q&As that we have open. So one of them is, if you want to purchase a practice within 15 years after graduation, but also want to purchase a home within the same period of time, are there implications/complications with borrowing money for either?
Yeah, so basically the bottom line is the bank will love you. They will give you dollar for dollar for buying for borrowing to buy a practice. So that's easy peasy. You can get that. All right. When it comes to your house, you're going to have to come up with a down payment, and the amount of the down payment is going to impact whether or not your mortgage is considered high ratio or conventional. And basically, a conventional mortgage is where you've got 20% or more down as a down payment. This is important because it'll save you a lot of money. Because if you have a high ratio mortgage, you need to have that mortgage insured. And I don't mean insured in the sense that, what if you die? No, this is insurance basically that if you don't pay it back. Okay. And so this insurance is literally thousands of dollars, first of all. The bank will be happy to apply it towards the value of your mortgage, which means you may have that outstanding debt accruing interest for another 20 years, as an example, right? So you really want to do your utmost to save up enough to have a minimum of 20% down so you can have a conventional mortgage. I'll also state as well that the banks are that much more willing to lend you money if you're doing a conventional mortgage. Why? Because you've got skin in the game. You're putting 20% or more down. That makes you a good risk or a better risk than someone who's putting 5% down, right? So, yeah, it's important that you have that money set aside. You'll probably end up buying a house before you buy a practice. That's what I see more often than not. Um, it's not impossible, but it does require a fair amount of effort on your part to get the down payment put together, and then qualify for the loan. The banks, when they're looking to qualify you for the loan, are really more interested in whether or not that practice is capable of bringing in sufficient revenue to pay the bill. So
Thanks, Shane. Um, we have, I guess, a bit of a follow-up to this one, but as Julie mentioned, life insurance can be assigned to the bank. Does it mean that I don't need to pay for mortgage insurance?
Okay, so I guess that is a bit of two parts. So the mortgage insurance that Shane was just mentioning, if you've put less than 20%, you're still going to have to do that. No questions asked on that. But if the bank is wanting life insurance in case you pass away, then yes, if you are signing your life insurance, then no, you don't need the mortgage insurance. So as long as you have sufficient life insurance to cover your mortgage should you pass away, then you do not need to pay the bank the mortgage insurance. But as Shane was alluding to that different type of mortgage insurance, less than 20%, irrelevant of life insurance, you're going to need to have that.
Thanks, Julie. Um, I love this next question. How do you find someone to make this personal financial roadmap, and what do you ask them? Is it too soon to do this while we're in school? Yes, exactly. You see, Shane, he's pointing at himself. We offer no cost, no obligation financial advice. And Shane, if you'd like to go from there.
sure. Yeah, so yeah, it's a member benefit, guys. So basically, if you're interested, you speak to myself or one of my colleagues who does what I do. All you have to say is, "Hey, I'd like a financial plan," and we'll take it from there. So we're going to ask you a throng of questions to basically get a better understanding as to what's important to you, what your goals are, what your timelines are, where you're currently what your current circumstances are, in terms of what you've got in terms of savings and how much you can save, what your debt looks like, how much you're paying back on that, what your budget looks like, what do you have for insurance, so we do a complete comprehensive financial plan. And yeah, you might look at that and go, yeah, but do I really need it? Yeah, you do, because ultimately at the end of the day, as Sam alluded to earlier, the power of compounding and things like that, it matters. It matters in a big way.
And it looks like we have one last question in the Q&A. Can you use your line of credit towards a down payment for a house?
Well, technically you can. However, the banks want to see your evidence of savings. So they're going to look at that and go, "Oh, I see you've got $100,000 line of credit, and you suddenly have, no money available on it, and you've got $100,000 in your bank account." And they're going to look at that and go, "No." They're going to turn you away, right? So you basically have to have that evidence of savings, right? That, your RSP, your first home savings account, your TFSA. And so, like I said, technically you can do it. You can, work it, if you really wanted to, you could take the money out of your line of credit and fund all those different accounts and make it seem like, you've been saving, saving, saving. Um, but if you just walk into the bank going, "Yeah, I want to use my line of credit to make my down payment," they're going to say no.
Thanks, Shane. And it looks like that's it for our Q&A portion. Quick plug for our socials as well. Like I said, we're coming to the schools. We come in the spring, we come in the fall. We go to the conferences. Please flag us down. We're coming up with some new content as well and new webinars. So please, please, please join us. Ask us your questions. Thanks so much, everyone, for joining. Thank you for the FCDSA for hosting us tonight.